We're always taught that building wealth is all about spreadsheets, fancy degrees, and just being plain smart. But what if that's not the whole story? What if a janitor could actually build a bigger fortune than a Harvard-educated executive? Well, it really happened. And understanding how is going to change the way you think about money forever. So let's meet our two case studies. On one side, you've got Ronald Read. He was a janitor, a gas station attendant in rural Vermont. I mean, his life was about as low-key as you can get. Then, on the other side, Richard Fuscone. This guy was the absolute picture of success. Harvard education, MBA, top executive at Merrill Lynch. He retired in his 40s to become a philanthropist. The resumes couldn't be more different. But here's where the story gets crazy. Their financial endings were completely flipped. Ronald Read, the janitor, quietly passed away with an $8 million fortune, leaving most of it to his local hospital and library. Meanwhile, Richard Fuscone, the finance hotshot, went completely bankrupt after the 2008 financial crisis. He lost his massive 18,000 square foot mansion in a foreclosure auction. So you have to ask, how on earth is this possible? How does the person with zero formal training, no powerful connections, no advanced degree, completely crush the guy who had literally every advantage? I mean, in what other field does that even happen? Well, the answer is the big idea of this whole explainer. See, financial success isn't a hard science like physics with all these strict laws and formulas. It's a soft skill. It's all about psychology. How you behave, your patience, your perspective, your humility is so much more powerful than the numbers on a spreadsheet or the degree hanging on your wall. All right, so to really get this, let's start with the first big idea, the fact that our own personal history with money completely builds our financial reality. And it's why something that looks completely insane to you might make perfect sense to somebody else. The book calls this the no one's crazy principle, and it makes so much sense when you think about it. Someone who grew up poor during the Great Depression is going to see risk in a totally different light than a tech worker who only saw bull markets in their 20s. Each one of them is making what they believe is a perfectly rational choice based on the world that they've personally seen and experienced. And you can see this in the data. Look, if you were born in 1970, you would have watched the stock market go up almost 10 times over during your teens and 20s. To you, stocks probably look like this incredible, can't-miss wealth-generating machine. But let's say you were born just 10 years earlier, in 1960. Your formative years weren't defined by a booming market. They were defined by crazy, runaway inflation that nearly tripled prices. You watched your family's paycheck buy less and less stuff. You learned a totally different lesson about money and savings. You see? Two different people, two completely different and deeply personal realities about how money works. And this gets to a really crucial point. The tiny, tiny sliver of economic history that we personally live through, it accounts for like 0.0000001% of everything that's ever happened. But that tiny slice makes up maybe 80% of our personal worldview on finance. We're all just kind of anchored to our own little slice of history. Okay, so our personal experience is a huge factor. The next thing we have to understand are two forces that are always at play, but we often forget about them. The identical twins of luck and risk. They prove that our success or failure is never, ever 100% in our own hands. Let's look at this incredible story. Bill Gates, he experienced a 1 in a million stroke of pure luck. He got to attend Lakeside, one of the only high schools on the entire planet that had a computer back in 1968. But he had a best friend, Ken Evans, who was just as smart, just as driven. They were going to build a company together. But Kent experienced a 1 in a million stroke of risk. He died in a mountaineering accident before he even graduated. Same force, same magnitude, just pointing in opposite directions. So what's the lesson here? It's that we have to respect both luck and risk. When we see someone with massive success, we can't just say it was all skill. And when we see failure, well, it might not just be bad decisions. It might be the unforgiving reality of risk. It's like Scott Galloway says, nothing is as good or as bad as it seems. Now let's look at what happens when people completely ignore these psychological realities. This brings us to one of the most dangerous behaviors in all of finance. The inability to know when you have enough and that constant, destructive need for more. This comes from a fantastic little story. The authors Kurt Vonnegut and Joseph Heller are at a party hosted by a billionaire. And Vonnegut leans over and says, our host made more money in a single day than your famous novel Catch-22 has made in its entire history. And Heller's reply is just perfect. He says, yes, but I have something he will never have, enough. And if you want a real-life case study on the danger of not having enough, just look at Rajat Gupta. This guy went from being an orphan in Kolkata to the CEO of McKinsey, worth a reported $100 million. But then he got on the board of Goldman Sachs, surrounded himself with billionaires, and suddenly he felt poor by comparison. He had to have more, so he risked everything he had, his freedom, his reputation, his entire fortune, for something he didn't even need. He committed insider trading, and he ended up in prison. This story just drives home the core lesson. The most important financial skill, and maybe the hardest one, it has nothing to do with investing strategies. It's getting the goalposts to stop moving. It's about controlling your own desires before they start to control you. Because true wealth is having the ability to look at your life and say, I have enough. So let's just end with this thought. We spend so much of our time and energy focused on accumulating, on strategy, on just getting more. But what if we've been asking the wrong question this whole time? What if the real key to wealth and even happiness isn't about earning higher returns, but about defining your own finish line and knowing when you've finally crossed it?